Hi, and welcome to Accounting 1, where we will be discussing accounting and business. So here are the learning objectives for the chapter. You can see there's conceptual ones, where we'll be explaining the purpose and importance of accounting, identifying users and uses of it, opportunities in accounting, why is it here? Explain our ethics. Explain generally accepted accounting principles and define and apply several accounting principles. We'll also be looking at some analytical stuff. Define and interpret what we call the accounting equation and each of its components. We're going to skip A2 and A3, and then we're going to look at the procedural, which is the heavy part of our chapter. We're really going to get in and start doing accounting. So let's take a look. What is the purpose and importance of accounting? You might have heard people say accounting is the language of business, and they're very true and correct when they say that. Accounting, by definition, is an information and measurement system that identifies and records and communicates an organization's business activity. So a company will take what they call transactions or business events that are financial in nature. So they identify those. Then they'll input them into an accounting system, which you're going to learn this semester, which is a chronological log of transactions. And it summarizes these transactions. These little pieces of financial information get summarized in this accounting system to prepare reports, which we call financial statements. Why do we prepare them? So that we can communicate information about the company, not only internally to the employees, managers, and owners of the company, but also to external entities such as the government. So let's look at these users and the uses of and opportunities in accounting. There it is. Accounting is called the language of business because all organizations set up an accounting information system to communicate financial data to help people make better decisions. Who's using this? Well, we have two major groups, external and internal. Internal to the company, meaning the managers of the company, maybe the research and development employee manager, the purchasing manager, the human resource manager who hires and determines employment for the company, marketing managers, how much can we advertise, what can we advertise, where should we advertise, production managers, what should we make, how much should we make, and distribution managers, how much can we sell? Okay, so these people inside are looking at the information that the accounting system provides to help make those types of decisions. Outside the company are many users as well who want to know about the company's financial situation. Lenders, such as banks or maybe suppliers. Auditors. An external auditor is someone who looks at the reports, the financial statements the company makes and determines how good are they? Can they be relied upon? Can people make decisions using these things? The owners of the company, such as the shareholders, if it's a corporation, the board of directors, which is a group that is part of the corporation, that is really the liaison between the company's, corporation's management and the shareholders. Regulators. Securities and Exchange Commission is one such regulator. They police public corporations to make sure that they're not being deceitful to the public. Corporations aren't being deceitful. The IRS, also interested, Internal Revenue Service. They are the police for the tax law. They want to make sure that companies, businesses are following the tax law. And customers, they may want to know about the financial information of the company. So you can see there's many different groups, both external and internal, to the company that are interested in it. Wow, so what kind of opportunities? If you decide you wanted to pursue an accounting degree, you're like, I really like this stuff. Some people usually love it or hate it. But if you really find an interest in it, it's a lot more than what you're learning in this class. For instance, one part is what you're learning in this class, the financial side, which the end result are financial statements, the preparation, the analysis, looking at them and explaining to people what they mean. Maybe externally auditing them. You're an accountant who audits financial statements. Maybe you're going to work in the regulatory end of it, maybe for the Securities Exchange Commission, the SEC, or the Internal Revenue Service. Maybe you're going to do consulting with the client to say, hey, here's your financial statements, and let's do this and this and this to help you make your business better and make it grow. Maybe on a planning side, you can help a customer or client, or criminal investigation. A lot of forensic accountants, you might have heard that term, where they go in and reconstruct financial information because of a criminal investigation. Managerial accounting. That's more of accounting done within the company. You might hear it refers to as cost accounting, budgeting. There's internal auditing, which is an auditor who works for the company, who audits the company to make sure that the company's doing everything it says it does, it should be. There's consulting as a managerial accountant. So that's a separate type of accounting. Controller. I was a controller for a bit. I worked for about 3 years at a trucking company, and I worked 2 years at WNEP as a controller. And they oversee the accounting operation. So I was a manager of the accounting department at both those companies. Or you could be a treasurer, or you could create strategy as a managerial accountant. There's also a taxation side of accounting. My master's degree is in taxation, where you are maybe working for a company or working even in public accounting, and you are consistently making tax returns for people, preparing them, helping people plan their tax future so that they pay the least amount in taxes. Maybe you in the regulatory side as an Internal Revenue Service agent. And estate planning, that's to help people plan for their taxes at death, because yes, we even pay taxes at death sometimes. So we're just giving you a feel for the types of careers you can go into with an accounting background, accounting degree. Then there's accounting related. You could go into banking. You could become a financial analyst. You could become a stock trader, a director, underwriter for insurance, an appraiser. You could become a litigation supporter, so you help a lawyer with situations. Forensic accounting, that's where a lot of the backside of you are helping reconstruct maybe records that were destroyed or where fraud was committed within a company, and presenting that in a criminal or a civil lawsuit and being an expert witness. About 5 years ago, people were like, I want to be a forensic accountant, but that's what you're doing. You're helping people value businesses. You're helping corporations merge together. I mean, some of this stuff might be really new to you, but it's just to show you there's a lot of opportunities within accounting. And the one thing I always say, and I'm not sure if it's here or not because I didn't flip through all the slides, is that if you are interested in becoming and involved in accounting, become a certified public accountant. And that is where you take a test. A very hard test, but you study really hard. After you finish your bachelor's degree, you take a test. In the state of Pennsylvania, you have to finish an additional 10 courses or 30 credits in accounting, business, areas like that, and then you could become certified if you have at least 1 year experience working with a CPA. And then after that, all you'll have to do is continue taking education courses. I know I have to take 80 hours of school every 2 years, and I just finished up my accounting credits, thank you God, for our next 2 years, or our 2-year cycle. So I'll be able to renew my license. And I've been a CPA for almost 30 years now, since 1992. So I don't work actively in the field, but I have the ability to go back and do any of these things. Some of them I've worked in, some of them I haven't. And I know some people are probably looking going, FBI investigator? Absolutely. You can become an agent with the FBI and just be an accountant. I know years ago I was considering that, and I talked to the representative from the FBI. I think you have to be 23 years old and you train to be an FBI agent, but you're going into work with a briefcase, you carry a gun, you have a badge, but you're not in the field actively hunting down criminals. You're doing the accounting side of it or investigating on the accounting side. So it's in all aspects of our lives, and you will do accounting in your regular day-to-day life if you've never become an accountant in your career. You're going to budget. You're going to save, you're going to pay taxes, and you're going to plan for the future. So keep that in mind. And if anybody ever has any kind of questions about going into the accounting field, please know my door's always open, or email or phone. Anything you may want to know about it, I have no problem talking to you. Ethics. Now, of course, in any profession, ethics needs to be dealt with and is very, very important. And if you're like, ethics, what exactly is ethics? Well, remember something. There's the law, okay? So there's decisions we make that we're either going to break the law or be in conformity with the law. There's decisions we make that will not hurt anyone, like picking our religion or picking our political party. Doesn't directly hurt anybody. And then the decisions in between are things that are lawful but may hurt somebody. And that's ethics. So the goal of accounting is to provide useful information for decisions, and it must be trusted. And that's why we need ethics. And as a CPA, I have an ethical code of conduct that I must follow, or I could lose my license. So ethics are beliefs that distinguish right from wrong, and they are accepted standards of good and bad behavior. So we should look at our concerns when there's ethics involved, look at our options, and then make the best decision, weighing all the consequences. And that's what we do, and that's part of our code. Intertwined with an ethics is a great topic of fraud. And it's been pretty prevalent, for the past 15, 20 years, especially in corporate America. We hear about people stealing or, doing shifty stuff in accounting and cooking the books, they call it. That's where they just put incorrect information on their financial statements, these reports. And the thing to remember, and I always tell my students in my regular day classes this too, is that there's always three things that have to be present for fraud to occur. And the first is usually a financial pressure. There's something that the person feels that they have to pay off a bill, they have to hide bills, they might be hiding bills from a partner that they need to get paid off. They might have to pay for health care, but there's some kind of financial pressure that's making them think of committing a fraud. Then there's rationalization. They process the fraud like, I deserve this. Like a lot of times people say, I work really hard here and I don't make enough money. I deserve this. But the last thing, and those are two things that are internal to the person. There's nothing really the company could do about that. But the last thing they can, and that's opportunity. So if a person has an opportunity to commit fraud, there's not safeguards in place, protections in place to stop them, they're going to do it. So rationalization of financial pressure is really internal to the person. But if we prevent them the opportunity, that will keep them in line. And that's why a lot of times you hear, oh, they stole from the Little League or the church, or the opportunity was there. Now, I know we're kind of flopping and flipping all over here, but here's the other thing, and this kind of ties back to fraud. Back in the late 1990s, there was a lot of corporate fraud that began to come to light for whatever reason. Taking you back about 60 years from there, in 1933, 1934, Congress, in reaction to a lot of accounting fraud occurring in public corporations, where they were reporting untrue information, on their financial reports, people were investing in the companies based on this fraudulent information. And then the stock market crash occurred. Now, the stock market crash, that was not the only reason, but it's the outcome from the stock market crash that made Congress respond. A crash is a crash. Oh, well, it happened. But then we went into a recession in our country. And then after a while, recession turned to a Great Depression. People lost their jobs. There was no safeguards in place to help these people. They were hungry, blah, blah, blah. It shaped a whole generation. And I don't mean blah, blah, blah in a flippant way. It's just, you probably know some of the story. And if you don't, talk to your grandmother, your great-grandmother, probably your great-grandmother. I know my grandmother lived through the Great Depression. And it really shaped the way she lived for her entire life. So in response to that, Congress created the Securities Exchange Commission to police public corporations so that these types of frauds would not occur anymore. And part of that was that they required companies to have audited financial statements by independent accountants or certified public accountants. And for many years, this helped alleviate any kind of fraud. Well, back in the late 1990s, what the foresight of this law did not see is that the accounting firm would either work intentionally or unintentionally with the corporation to commit fraud. And that's essentially what started happening. And it was one firm really that was behind all of these fraudulent public companies coming to light, and that was Arthur Andersen. They're no longer an accounting firm. They no longer do audits. But you might hear the term Enron in some of your business courses, and that was a company that had a huge fraud and billions, millions and billions of dollars. But what was so bad about it was that it employed 6,000 people. The company employed 6,000 people in Texas. They lied on a very complex financial situation, and the auditors either didn't find it or kind of just said, yeah, that looks good to us, and let it go. And when the fraud came out, the stock price went to zero. People lost their jobs. Many people, 6,000 people in Texas lost their jobs. And then on top of that, a lot of them had their retirement invested in Enron stock. The stock value goes to zero. The value of their retirement went to zero with no safeguard to help them, meaning there was no repercussion for them to come back and say to the company, we want our money back. There was no money. So in response to that, Congress decided to pass even more stringent and strict rules when it comes to public companies. And specifically, it does a couple things. First, it makes sure that the company is running so fraud could be prevented. And that's called internal controls there. And it also has stricter rules on auditors of public companies. That's what you need to know for now. We'll go into more detail later in the semester. And if there's any kind of fraud detective and the executives knew about it, they have stiff penalties and criminal prosecution. So this is a newer law, like I said. It came out in 2001, 2002, so it's about 20 years old. It came out after I left public accounting, but this is why it's there. And so it's very important in our accounting world. There's also the Dodd-Frank Wall Street Reform and Consumer Protection Act. It has two major provisions, and that came out, I think it was in the later 90s. Clawback provision, which mandates recovery of excessive pay, and a whistleblower provision, where if a person within the company knows there's some type of fraud, that they can come and bring it to light to the public without any kind of repercussions coming back at them. Okay, so that's some background, some information about accounting that has brought us into today's world. Now, what are the rules of accounting? So what we're going to look at are the generally accepted accounting principles, and we're going to define and apply them to several accounting principles themselves. So we have this thing called GAAP. It's an acronym. We use tons of acronyms in accounting. CPA, Certified Public Accountant. GAAP, generally accepted accounting principles. And I like to look at GAAP as a big umbrella, like a big beach umbrella. And and you could think of everything under the umbrella as being our accounting rules. So financial accounting is governed by concepts and rules known as GAAP. So GAAP is the name of the umbrella that all the rules and concepts fall under. And the major objective of GAAP is to make sure information is relevant. So it's relevant information is stuff that will affect decisions of users. It's reliable, so it can be trusted, and it's comparable. So you can compare yourself to your peers in your industry. Now, before we look at international standards, the current body that makes GAAP in the United States, which we're the only country in the world that uses US GAAP, is called the Financial Accounting Standards Board, the FASB, FASB, Financial Accounting Standards Board. They're a group of 7 people who meet in, well, they're business professionals, accountants, economists, marketing people, etc. And I'm going to really simplify it, but they make accounting rules, financial accounting standards in the United States. We're the only country in the world that follow them. Most other major financial countries follow international accounting standards, which is the slide you see in front of you now. The Financial Accounting Standards Board make financial accounting standards for international accounting standards board make international financial reporting standards. The United States doesn't say we don't want to follow you because we think we're better. It's just we were going to start following international accounting standards, and then we had a devastating recession. They called it the Great Recession from 2007 to 2009. And that was during the time period we were supposed to adopt these new accounting rules. Well, the Securities Exchange Commission put the adoption of these rules on hiatus and said, let's wait. Let's wait until we're in a better economic situation. And then we'll look at it again and make some decisions if we're going to change. And the reason is because it's very expensive to change accounting rules. Software needs to be changed. People need to be trained. Users of these reports need to be trained to understand. That's not cheap. So right now the SEC, Securities Exchange Commission, has not adopted a new timeline. It's kind of like they said, well, maybe we won't adopt them. We may wait. So stay tuned. Okay, but everybody else in the world uses these. What do we use? Well, the good news is the Financial Accounting Standards Board, that's the United States Standard Setting GAAP Board, and the International Accounting Standards Board, ISBA, work together. So the first major undertaking was doing what's called the Conceptual Framework. Now, we've always had a framework, and you could think of that as like your basement in your home. You know, that's where your house starts, right? And everything else builds on top of it, and you go back to it. Well, that's what a conceptual framework is in accounting as well. And we both use the same conceptual framework. So what do we use it for? To create new rules in accounting. And the major standards setting guidelines, this framework, are objectives. The objectives of any financial information, whether it's international or in the United States, is to provide information useful to investors. You could think of those as owners, creditors, such as the bank, and others who may be affected by the financial information. There are qualitative characteristics that need to be present to require information. So we only really look at information that is relevant, so it'll affect a decision maker. It's reliable, it could be trusted, and it's comparable. You could look at the same type of information in a competitor. There are elements. There are specific items that financial statements can contain, and we're going to talk about those. Recognition and measurement. This sets a criteria that an item must meet for it to be recognized as an element, one of those items before it, and then tells us how to measure that. Okay? Do we do it at what we paid for it, what it's worth, or some other value? So that's what our conceptual framework looks like, whether it's international accounting or United States accounting. So part of this conceptual framework are principles, assumptions, and constraints. So general principles are assumptions, concepts, and guidelines for preparing financial statements. So principles in our little house of GAAP there, our big umbrella, there's measurement, full disclosure, revenue recognition, and expense recognition. Assumptions, going concern, monetary unit, time period, business entity. And then cost benefit. That's a constraint. And we're going to talk more about that. Now, specific principles are the detailed rules. So this is part of the framework, what we're looking at here, the general principles. Specific principles are specific rules we look at that are beyond the framework that we use to report business transactions and events. Now, I don't want you to think that we are going to be learning just a bunch of rules and numbering systems. No, we need to introduce you to these rules so you understand why we do accounting the way we do it. It's part of a system that was well thought out. So let's go back. We have the measurement principle, or what we call the cost principle. In the United States, accounting information is recorded based on what we pay for something. And then we just let it at that amount in our accounting records while we own it. We don't increase its value for inflation or decrease its value for deflation. We don't increase its value if it goes up in value. So think of it this way. 40 years ago, you buy a piece of land in your business for $500. Just a piece of land. You put it in your accounting system. I paid $500 for this piece of land 40 years ago. What was that? 1979. Ooh. It's now 2019. You're thinking about selling that piece of land. You've been cutting the grass, maintaining it, but haven't done much else with it. So you go and have it appraised. And the appraiser says that they could sell it for $15,000. What amount will be in your accounting records in 2019? $500, because that's what you paid for it. So you want to be careful of that. So we never say when we're dealing in accounting, well, it was worth $500. No, that's what you paid for it. That was its cost. The next principle is the revenue recognition principle, and this is a really important principle. This tells us when we recognize revenue or what we charge a customer. Okay, so what it says is this. If we did something for a customer, we provided a service, or we gave them a product, we have what's called revenue. That's what revenue is. It's the amounts we charge our customers when we provide them the product or service. The expense recognition principle says, oh boy, I don't like that. Excuse me. A company records its expenses. So what expenses you could think of are as the amounts it costs to run the company. Things like services you have to pay for to run your company, like utilities, rent you have to pay, taxes, advertising. These are all expenses, and they should be recorded when they occur. So when you received that service. The full disclosure principle, another major principle, says a company reports the details behind any financial statement information. So anything you report to on your financial reports, You need to give more detailed information in what's called notes to the financial statements. And we'll be seeing that later on. We just want to make you aware of it. So in accounting, we actually write a lot. Not only will we give numbers on reports, but we'll also give complete explanations of what those numbers mean, because not everybody is an accountant and would know that, right? Some assumptions we have in accounting. The first is the going concern assumption, and that is when we're creating accounting rules and doing accounting, we assume the company will continue to operate in the future. Now, if you're sitting there going, well, how do you know it's not? Well, that's different. We know it's not going to operate. But if we know there's no indication that it may stop, we assume it's going to continue. The monetary unit assumption says record all transactions in terms of a monetary unit. So in the United States, dollars and cents. If you were in France, it would be the euro. Okay, but in the United States, we're using dollars and cents. Business entity assumption states that a business accounting needs to be separate from any other business or owner. So if I own a company, I'm a sole proprietor, one owner of a company. My company has accounting, I have accounting. Okay, so my company puts in, rents a building. I don't go back to my personal checkbook and say that was something personal. Just like if I put in a swimming pool at my house, I don't go to the company and say, oh, the company bought a swimming pool. No, it didn't. I did, personally. So we keep the accounting separate. Time period assumption is that we do measure information in terms of artificial time periods, and it's usually a year. Okay, so you're going to see, we're going to be doing something called the accounting cycle, and the accounting cycle usually lasts for 1 year. So the different types of businesses are proprietorships, partnerships, corporations, and limited liability company. Now I know this graphic is very small, but these take you through the different, the definition and some of the major advantages and disadvantages of each. So a sole proprietor is one owner, very easy to set up. There's no additional business income tax on a sole proprietorship. It's probably one of the best taxed entities. The owner, though, has unlimited liability, meaning they're personally liable for any debts of the business. So if the business can't pay its debts, then the owner must pay them. And if the owner can't pay them, the owner files for bankruptcy. It's not a separate legal entity. So in the eyes of the law, the courtroom, the business and the owner are the same individual. And the business life ends when the owner passes away. Now, it doesn't mean the business ends. It just means a new sole proprietorship is formed, or the business ends because there'll be a new owner. With the partnership, it's very similar, but now you have more than one owner, and we call these partners. There's no additional business income tax. They have unlimited liability like a sole proprietor, but now it's shared among the owners. Just like a sole proprietorship, it is not considered separate from its owners in the eyes of the law. And the business ends when one of the partner dies or leaves or is added. Corporation. Corporation is a separate legal entity from the owners in the eyes of the law. So in order to form a corporation, the company must file papers, permission slip, basically, papers with a state, any state. It's not ruled by federal law, but state law, and each state has their own corporate law, to ask permission to operate as a corporation under their state laws. The corporation will then give a corporate charter to the company so that now it could be recognized as a corporation. It is at this time that the corporation can sell ownership to stockholders. So they sell shares of stock to owners, and these owners are called stockholders. There are additional corporate income taxes when it comes to a corporation in the traditional sense, meaning a regular run-of-the-mill corporation. Now, there are different variations of it, but for our purposes, that's what we want to remember. Limited liability of the owners, though, in contrast to that sole proprietor and the partner, if a corporation is being sued, it is considered a separate legal entity. So it is the corporation, the company being sued, and not the owners. So the most a shareholder can lose is what they paid for the stock. And again, it's separate entity, and so it doesn't die like a natural person does. So it goes on forever until the business, it's decided to shut it down. A limited liability company is the mixture of a corporation, a sole proprietorship, and a partnership. So there's one or more what we call members. And there's no additional business income tax. So it's like you're a sole proprietor or a partnership when it comes to taxes, but you're like a corporation when it comes to liability. So there's limited liability to the owners or members, and it's a separate entity, so it goes on indefinitely. So these were really created to help the tax situation of small companies so that there wasn't additional business tax, but there was protection for liabilities for the owners. And those are your four major types of businesses. The most popular right now for small, medium-sized businesses are limited liability company due to the amount of litigation that occurs. You know, somebody spills coffee on themselves and they're winning $1 million in a lawsuit. So we need to take that into account, and that's why that LLC has become so popular now. Some accounting constraints. The first is cost benefit. So there's a cost of collecting information and there's a benefit that information gives us. So only information with benefits greater than their costs to collect. So the benefits of disclosing the information is greater than the cost to collect it and disclose it. It's only that type of information we deal with. So if it's going to cost more than it's going to benefit the user, it's normally ignored. Materiality is another constraint in accounting. And what we say with materiality is that if a piece of information were different, so if the value of, or I shouldn't say value because we're talking about cost principle, but we will get into that. But if you're given a rule in accounting and it says you must do accounting this way, and you kind of didn't do it that way, you did a little differently, it's okay as long as that dollar amount is not significant or material to the entire company. So let's say you accidentally put something in a wrong category, and we're going to be talking about the categories in a minute. You put something as an asset instead of an expense for $100. Well, materiality-wise, it says, well, if your business is $100 million, does that $100 really matter? It's not a big deal if it's not in that correct category, because that sorry, I'm stuttering over my words here, but you having it in that different category than it needs to be isn't going to influence the decision makers. It's only $100. But if you put, $2 million in a wrong category when you have a $100 million business, now that's going to be material. That's going to be more significant, and that may influence a decision maker. So we're very careful with significant amounts or material amounts, and that's what we mean by materiality. Only information that would influence the decisions of a reasonable person need to be disclosed and need to be correctly accounted for. So we've looked at that entire conceptual framework, and you got a great overview. And throughout the semester, I'll bring those items up again. because they are pretty significant in how we do accounting. That's why they're there. But for now, we're going to move on to our next area, which is defining and interpreting the accounting equation and the components. So here's our accounting equation. Assets equal liabilities plus equity. Now, the types of businesses we'll be working on in the semester are sole proprietorships. And the first type of sole proprietorship we'll be working on is a service business, meaning they provide a service to make money. They don't sell a product. Later in the semester, we'll sell products. But for now, we're just going to provide maybe a mental service or a physical service, but we're selling our ability to do something for somebody else, not sell them an object. Assets equal liabilities plus equity. Assets, anything the company purchases and owns. Cash is an asset. Furniture, buildings, land, supplies. These are some of the common assets you're going to see in the beginning. There's another asset called accounts receivable. And accounts receivable is where the company keeps track of any amounts customers owe to them. And you'll be seeing that as we expand this equation, okay? But those are some typical examples of assets, things we own that we pay for. People will say, oh, well, employees are an asset. In a business sense, they are, but they're not an asset in our accounting equation. We don't buy them. We may think we own them, but we don't buy them. Liabilities. Liabilities are any amounts the company owes to creditors, the bank, suppliers. Okay, so the two typical type of liabilities you're going to see is something called accounts payable. And accounts payable is where the company keeps track of amounts it owes to suppliers. If they don't pay their bill when they get it, then they will owe that money. The other typical one is notes payable, and that's where companies keep track of the amounts they owe for loans to banks, notes payable. And sometimes we vary the terminology, the words, and we use some like synonyms there. And we'll see that, and I'll point it out to you. Then we have equity, and there's four major parts of equity. The first is owner capital. What do we keep track of in here for now? We keep track of all amounts the owner invests in the company or gives to the company. Because remember, an owner has to take their personal money to start the company, or their personal assets that they own, put them into the business and start the business. So anything the owner contributes into the company is kept track of in owner capital. Notice, owner capital increases the equation, but owner withdrawals decreases equity and the overall equation, and that's true. So we always want to keep track of all the amounts the owner takes out of the business. And the owner can take out of the business, they own it. Revenues, I already discussed revenues a little bit. This is where we keep track of the amount we charge customers for our services. So anytime we do something for a customer, we have a revenue. In the revenues, we'll keep track or increase our revenues. And their overall effect on the equation is to increase it. And then the final item are expenses. Remember, we talked about this a few minutes ago. Expenses are amounts the company has to pay for services it receives to operate the business day to day. Now, expenses decrease the accounting equation. If we take revenues, money coming in from doing stuff for our customers, minus expenses, the cost to receive services so that we can run our business, the difference between that is either profit or loss. In accounting, profit is called net income. If it's a loss, we call it net loss, and we use that term all through accounting. So please don't start calling it profit. It's net income. So that's a general look at our equation and what each item means. So you need to know the definition of these so that when we start using this equation, it's automatic for you. You can't stumble on these definitions. So we're going to start analyzing business transactions and putting them into the equation, because this is our first part of accounting. And everybody says, oh, I don't like accounting, it's math. No, math, it's add, subtract, multiply, and divide. That's all we do in accounting for the most part. Probably the harder part, the technical part, is analyzing, thinking about what happens in a transaction, a financial event, and figuring out where to put it in that equation we just looked at. So we're going to start small, and then we'll expand and grow on that. So take a look. And you should write your accounting equation in front of you. Assets equal liabilities plus equity, and those 4 parts of equity. Chase Taylor invests $30,000 cash to start a business named FastForward. So what's happening here? Chase Taylor, an owner, puts $30,000 of his own personal money into a business called FastForward. So we don't worry about what Chase is happening to him personally. What we focus on is what's happening in the business. So right away they come right out and use the word accounts. Each asset will have its own area to keep track of stuff, or we call them accounts, and we'll be looking at that more in chapter 2. So if we had a spreadsheet showing us all the assets, we would have a cash column, accounts receivable column, supplies column, whatever assets we have, they would all have their own separate column. So what we're looking at here is what was affected by this transaction. Well, cash was affected, which is an asset, and it's increasing because there's more money coming in to the company. What else was affected by this transaction? Well, think about what this money is. It's an investment by the owner. So over in the equity side of our equation, in the capital column, we would increase the equity C. Taylor capital by $30,000. Now, if you're saying, well, how could you have 2 things affected by one transaction? Remember, this is a balancing equation. Assets must always equal liabilities plus equity. So after you record a transaction, at least 2 things must be affected by the item. And in this case, they both increased. So I don't want you to fall into that trap of if one increases, one decreases. No, that doesn't mean they equal. Okay? So in this case, the assets increased and the capital increased. So there's the spreadsheet. So we have assets, we have a cash column, supplies column, and equipment. Those are the 3 assets that Chase Taylor is going to have in his business. On the liability side, we have accounts payable and notes payable. We talked about those. And then the equity, he has 1 column so far, C. Taylor capital. We put positive $30,000 in cash, positive $30,000 in capital. Assets equal liabilities, which are 0, plus equity. So that's how we take a piece of financial data, analyze it, and fit it into our equation. Let's take a look at another. Our second transaction. The company purchase. So now whenever you see a transaction, if it doesn't say the company, you assume it's the company. So nothing with Chase will be bothered with personally. So now the company purchased supplies by paying $2,500 of its cash. They didn't use the owner's cash, they used the company's cash. Even though the owner put it in, it is considered the company's cash. So you ask yourself, what was affected in this transaction? What happened? Well, we purchased supplies, which are an asset. The assets increase. The supplies asset increase. Okay, do we pay for them? Yes, we paid cash. So the asset cash will decrease. Let's see this in the spreadsheet. Now, in our spreadsheet, we decrease the cash column, increase the supply column. Don't get stuck in the rut of if something happens on one side, it has to happen on the other. No. Just as long as after recording the transaction, assets equal liabilities and equity. So take a look. When the company pays $2,500 for supplies, they just decrease their cash. It now has a balance of $27,500. But they now have a new asset called supplies. Add those two assets together. Assets equal $30,000. Liabilities are 0. Equity, $30,000. Take a look at number 3. The company purchased equipment for $26,000 cash. So what happened here? They bought another asset. They bought equipment. Equipment asset increases. They used cash from the company to pay for it, so the cash asset decreases. Look at our spreadsheet. Here it is coming in. $26,000 decrease in cash, $26,000 increase in equipment. So when we subtract that item from the cash column, now our cash balance is at $1,500. Excuse me. Our supplies are at $2,500, and now we have another asset, equipment. Add up all the balances in the asset columns, they'll equal $30,000. Liabilities are still at 0, and equity is still at $30,000. Assets equal liabilities plus equity. Transaction 4. Now the company is going to purchase supplies of $7,100 on credit, and they'll also say on account. So what this means is that the company bought supplies, so they have a new asset, supplies, so they're going to increase their supplies asset account or column, but they didn't pay for them yet. So now they just created a liability. And remember, they bought this from a supplier, supplies, so they're going to increase the liability accounts payable to show that they owe that money. So let's go over to that. I want to talk a little bit more about that. Here's your supplies asset increasing. It now has a balance of $9,600. The other two assets still have the same balance. The liabilities are positive $7,100 in accounts payable. Now, a lot of people look and go, no, liabilities are negative. Not in this case, they are, but we're trying to figure out how much we owe. So if we owe money, that needs to have a positive balance. If it's negative, it looks like somebody owes us money. Okay, so be careful of that. If we take our new liability balance of accounts payable plus our equity, assets equal liabilities and equity. Now, let's look at transactions involving the rest of those equity items, revenues, expenses, and withdrawals. So those first sets really just focused on purchasing assets with cash, purchasing assets on account, and the owner investing money. Now, when the company provides consulting services, remember what I said, sole proprietorship, going to be providing services to a customer and received $4,200 cash right away. So the day they did the service, they got the cash. They're going to increase their cash column asset, $4,200. They're also going to show that $4,200 as revenue because they completed the service. Remember, the revenue recognition principle says recognize revenue when you complete a service for a customer or provide them with a product. They did that. So take a look. Now we're going to expand out this equity section of our spreadsheet. Cash increased $4,200, and we're going to add up all the revenue. And that's how you can think of that. Revenue column, you're just going to keep accumulating and accumulating. You cannot return a service, so you'll never decrease this revenue column. You'll only increase it for our purposes. Because we want to collect and know how much revenue did we make? How much services did we provide to our customers? Now, sometimes they pay us immediately, like the case here. Add that to your cash balance. Your cash plus supplies and equipment will now equal $41,300. Accounts payable plus your capital plus your revenue, because revenue has a positive impact on our equation, equals total assets. Take a look at the next one. Paid rent of $1,000 and salaries of $700. Remember what we said, these are services being provided to the company so that they can run their operations day in and day out. These are expenses. So we want to decrease the cash column for the total amount of those expenses we paid, because that's how we're paying for them. When you see that word paid, cash is going out the door. But we will keep track of rent expense and salaries expense in their own separate columns in the equity area. Now, notice there's increases and decreases there, and you're like, which is it? What you have to remember is an expense always has a negative impact on the equation. But just like revenue, we always want to add the amount into the rent expense or salary expense column, so we accumulate a total amount of each expense for a time period. Take a look. So remember our equation, assets equal liabilities plus equity. And equity one broke out further and it said capital increases, revenues increase, but expenses have a negative impact. Okay, so we add these two together to get our total amount of expenses. Now in our spreadsheet here, we just have one expense column, and that's fine. We'll break out and do, we'll show you that in a later chapter if we don't get to it in this chapter. We just want to get a feel for how we're supposed to record these items. So there's our cash balance decreasing $1,700. And then if we take accounts payable plus investments plus revenues minus expenses, they'll equal total assets. In the next transaction, we provided consulting services of $1,600 and rents facilities for $300 to a customer for credit. Wow, that's a lot of stuff. So here now we have two different types of revenues. Let's focus on those. We did a consulting service. So we did our main source of activity, which is doing consulting for a client, and charged them $1,600. So our consulting revenues area increases. We also rented to them facilities for $300. So we provided them with that service. So they owe us, we charge them $300. So that's a separate rental revenue column. Now, it doesn't say anything about the customer paying us. So the day we completed the services, we have revenue, but we don't have any cash. So we now need to increase a new asset we talked about a few minutes ago called Accounts Receivable. And remember, Accounts Receivable is an asset where we keep track of any amounts a customer owes us. So just like we could owe a supplier, our customers can owe us, and it's considered Accounts Receivable. And there it is on our big spreadsheet. So now we have a cash asset, accounts receivable asset, with a balance of $1,900 to show our customer owes us $1,900. The supplies and equipment are still there. We still owe the $7,100 on accounts payable. Capital is still at $30,000. We added an additional $1,900 to our revenues. So now we're up to $6,100 of revenue for this time period, and we still have our expenses of $1,700. Our next transaction, the client in number 8 pays the $1,900 for consulting services. So what happens when the client actually pays us? Well, our cash increases, right? We got the $1,900. But what else happens? Well, we didn't provide them another service, so we're not getting more revenue. What's happening is the balance in accounts receivable will decrease. That customer no longer owes us that money. Take a look. Before this transaction, they owed us $1,900. When they pay us, we must decrease that balance so that the balance is zero. They no longer owe us that money. And then that will cause our accounting equation to balance. So it's all about balancing. The next payment. FastForward pays $900 as a partial payment for supplies purchased back in transaction 4. Now, because of the way I'm recording this, I can't flip back there, but that doesn't matter. We know how much they're paying. We purchased supplies back on transaction 4. We increased supplies and we increased accounts payable to show we owed that money. Now we're going to pay off $900 of it. So definitely the cash account decreases because we're paying $900, but our liability account also decreases, or our column there, because we no longer owe that much of the money. Take a look. We originally owed $7,100 in accounts payable. If we pay off $900 of it, our balance goes down to $6,200. And our cash column decreases as well. Take cash, supplies, and equipment, add them up, $40,600. Accounts payable plus capital. Remember, capital increases the equation. Revenues increase the equation, but expenses decrease. And when you net those four numbers together, assets equal liabilities and equity. I think this is our final one. Withdrawals of cash by the owner. So the owner withdraws $200 cash for personal use, and the owner can do that. So they took $200 out of the business checking account. So cash definitely decreases. What we want to do is keep track of all the money the owner takes out of the business. Where do we do that? In the withdrawals area and equity. Take a look. Now we have a new column, and now we have all four parts of equity represented on our spreadsheet. Cash decreases, and then we show the decrease in a separate column called withdrawals. Withdrawals have a negative impact on our equation. So cash went down, plus supplies and equipment, got $40,400. Liabilities are now at $6,200 in accounts payable. Capital is added, withdrawals are subtracted, revenues added, expenses subtracted to get $40,400. So I know that's very small, and you can see this in your book, but there's a summary of everything we did in one big spreadsheet. So that's really your first, like putting your big toe into accounting. It's taking a transaction, a financial event, reading it, thinking about how it impacts the equation, assets equal liabilities plus equity, and then recording that impact like we did. Okay, so that's a big part of this chapter. You need to know how to do that. You can't walk out of chapter 1 without knowing what an asset, liability, and the different parts of equity are, and knowing how to record those transactions. The next major part of the chapter are the reports. So we're going to identify and prepare the financial statements. We take information off our spreadsheet, which is our summary sheet back in the accounting department, and create a formal report. Kind of like when you do research for a term paper or a research paper, you have all these pieces of data, you summarize them together, and then you create your final paper that you turn in. That's the same kind of concept. So what are they? There's 4 major financial statements, and you're only going to be responsible for 3 of them for chapter 1. The first one is the income statement. And the income statement is where we take a company's one little part of equity, their revenues and their expenses, net them together, and determine if the company had a net income, remember profit, or net loss for a period of time. And that period of time will be the same period of time that we collected the transactions for. So we would need that defined. The next financial statement is the statement of owner's equity. This shows how owner's equity changed over a period of time. So if the owner put more money into the company, took money out of the company, if the company had net income or loss, it would be accounted for on this statement. And we'll take a look at that. The final financial statement you need to worry about knowing for chapter 1 is the balance sheet. And this is where we let people know what assets we own, what liabilities we owe, and what the final balance in owner's equity is at a certain point in time. And it's usually the last day of the time period we're reporting for. Now, there is a final financial statement, and you'll see it in your chapter. I'm going to tell you what it is, but you won't be tested on it. It's called the statement of cash flow. And what a statement of cash flow reports to decision makers is how a company spends its money over time. And there's three major categories: how they spend their money in operations, or how money comes in; how they spend money or money comes in for investment activities like buying new assets; and how the company finances itself cash-wise. Do they take loans? Does the owner give money? Does the owner take money out? Okay, so there's a lot of different items, and you will learn a statement of cash flow, but in Accounting 112. So you're going to see it in your graded problem. I'm going to ask you to complete it, but I give you the answer key just so you can become familiar with it. But as I said, you're not responsible for it with testing. That is very small. Let me see if I don't think I can make that any bigger. Hopefully you have it in your book, but you can see here's FastForward's income statement. So taking the information off the spreadsheet, we know that they had consulting revenue and rental revenue. Take notice, the very first line item, we call that a heading. It's 3 lines: the name of the company, the name of the financial statement, and the period of time that the transactions were for. So we have here FastForward, income statement for month ended. So this was only for the month of December. Month ended December 31st, 2019. Very first items on an income statement are revenues. This company had 2 major revenues. They had consulting revenue and rental revenue. Take that right off your spreadsheet, move it over onto this formal report. Add those 2 revenues together and label it appropriately total revenues. We then list the separate expenses: rent expense and salary expense. So we just don't write revenues and put a total and expenses and put a total. We actually list them out separately so decision makers can see here's where they got their revenue from, and here's the different kind of expenses they have to pay for to keep their business running. Notice also we do not put expenses in brackets on the financial statements. Decision makers know that they are negative overall on the accounting equation, and you would subtract expenses from revenue. So we total our expenses, subtract it from total revenues, and if it's a positive result like we have here, we label it net income. We then double underline the net income amount to indicate it's the end of that financial statement. So that is your first financial statement, the income statement. Now we do that first because we take information from that financial statement for the next financial statement, the statement of owner's equity. Again, we start with our heading, FastForward, company name, name of the financial statement, statement of owner's equity, and the time period. So we're showing how equity changed for the month ended December 31st, 2019. Now, if we are showing the balance of equity, where did equity end up? We always need to start with the beginning balance, the beginning of the time period. Since this is a brand new company, it's kind of like when you open up a brand new checking account, your balance starts at 0. Then you'll add any increases to equity. Investments by owners increases equity. And you don't have to list revenues and expenses separately on a statement of owner's equity. We already did that on the prior financial statement. And if we have net income, that will increase equity because our revenues were more than our expenses. If it's a net loss, we will decrease equity. But for now, we're going to add that to our investment. Then we subtract any withdrawals made by the owner. So the balance of equity capital for C. Taylor on December 31st, 2019, I can't see that. It's like 34, I think. I'm sorry, and I apologize. 34,200 if my eyes are seeing it correctly. I don't have the book in front of me. And I don't want to stop the presentation to look for it, but you could see in the final blue. The final financial statement, as I said, that you're responsible for is the balance sheet. Now, you're going to start with the company name, balance sheet, and this is as of a specific date, the last day we're reporting for, which is December 31st, 2019. What is this showing? It's showing you all the assets you own on that date with the amount that you paid for them, liabilities you owe, and equity you owe to the owner. Fast forward. So assets would be cash with its final balance on the spreadsheet, supplies, equipment. So if you're going, I'm just transferring. Yes, because you need to make a formal report. Add those three amounts up, total assets. Double underline the total asset amount. Go to the right side of your balance sheet, start with liabilities. You notice there's a heading there for liabilities. Accounts payable with its balance. That's your only liability, so you can total that and put total liabilities. Then in equity, you don't have to rewrite all that stuff we saw in the spreadsheet. We did that on the statement of owner's equity. So all we're going to do is carry down that final balance we had on the statement of owner's equity onto the balance sheet. Add your liability balance to your equity balance. Total liabilities and equity will equal total assets. You can see how they all link together. Now, there is the statement of cash flow. Like I said, we're not going to focus on that. Okay, I'm not going to be covering return on assets. I think it's a little early in your education in accounting to go into these. You will learn all about them in Accounting 112, but you could take a read through if you're interested. If you have any questions, I'll be happy to answer them. And we are not doing any of the appendix. Okay, so I'm going to end our presentation here. So before I do though, wow, we went through a lot here, didn't we? We went through and talked about different forms of business, the different groups that are involved in creating accounting and where accounting came from and where it's at now. We talked about the conceptual framework and all the assumptions, constraints, and principles, and you want to be really familiar with those. And then we got into the accounting equation and really dove in. We now understand what each element is, the assets, what an asset is, what a liability is, what the different parts of equity are. Then we learned how to take a transaction, one event, one business event that's financial in nature, and analyze it and record it into the accounting equation. We did that with a whole bunch of transactions, and then took those final summary totals and created the three financial statements, the income statement, statement of owner's equity, and the balance sheet. So these are the major items you need to come out of this chapter knowing, because if you don't know the information from chapter 1, you're not going to be successful with chapter 2. So please be sure that you listen to this as many times as you have to, and you ask all questions you may have.